Well, thanks, Alicia. It's been a bit of a directionless week on the local market, with Greece's debt worries continuing to hang over markets globally, and a bit of profit taking after the recent strong run. Here for his regular analysis of what's driving the markets is Chris Meyer. He's the CEO of RMB Morgan Stanley. Chris, thanks for coming in today. Well, you came in at the end of last month, just ahead of the Morgan Stanley Global Finance Conference. You went to that conference. What came out of that?
Yeah, I've been going every year for sort of 5 years. Last year was very much a will the bank survive theme to the conference. This year was much more around what is the new normal operating environment for these banks. And I think there wasn't great clarity, I thought, amongst the management teams presenting. And this is, European, US, UK, retail and investment banks about the outlook. Particularly concerning, I thought, amongst the management teams was hope that regulatory, Basel III as they call it, regulatory oversight will be pragmatic and sensible. But no one had any clarity around what it might entail. General perception that returns for the banking industry will be lower, driven by two factors. One, higher capital requirements, and two, lower risk-taking ability by banks forced on them by regulators. So, I sort of came away with a sense that banks are trading at about 1.3 times tangible book value, generically, across the sort of developed markets. And I don't think that that's that attractive, for a banking industry that will probably generate something in the low teens kind of return on equity. So, usually what you would have coming out of a sort of recession into a recovery, which is really where we are today, is that banks would be just great geared plays on an macroeconomic recovery. And I think they're going to be held back this time by the fact that there's uncertainty around what the new normal environment is for a bank.
Does that go for South African banks as well? Because of course we are going to have to fit into that new normal. We follow those global regulations. So would the same apply to them? Yeah,
I think some of it will apply. I think frankly the returns here will be higher. The South African banks were present there. Standard Bank, FirstRand and ABSA were at this conference. And they were talking about a 20%, sort of low 20% kind of return on equity. So already you've got a higher ROE here than you have abroad. And then I think from a regulatory environment, some of what they will implement in Basel III will be implemented here. But if it's draconian, I think because the banking industry here is much more sound, if you like, than offshore banking industries, the regulator hopefully will adopt a more practical view in terms of the implementation of Basel III to the South African banking system.
Of course, with Basel I and II, South African banks were well ahead in the implementation, weren't they? Yeah,
they were. And I think, look, obviously what got the banks into trouble internationally was irrational lending, frankly. Their sort of underwriting practices for extending loans got out of hand. And I think the South African banking industry has been much more disciplined in that regard, and so they should take credit for that. And therefore, I think it would be an overreaction to implement developed market banking rules if they're draconian on a banking industry in South Africa that's actually been quite well behaved.
Of course, Greece's troubles continue to weigh on the markets globally, and of course there is a concern about a default there. In fact, I heard credit default swaps in Greece were now
blowing out,
blowing out, and worse than Iceland's credit default swaps. And to what extent was that discussed at the conference? Is that a concern for
so
market players?
the Greek bank management teams were there, and obviously they put a positive spin on things, and their argument is that actually we have got access to funding because the ECB is still taking our paper, our bonds, and using it as collateral to return cash to us if we've got a liquidity crisis. And they own quite a lot of real estate in Europe, so their stopgap, if you like, is that if things really get bad, we can always sell some of this real estate we own in Europe. Now, unfortunately, the latter is a very illiquid asset, so who knows whether that's real or not. And on the former, the ECB does still take Greek bank bonds and sovereign bonds as collateral at the window, as it's called. But I think there's a decent risk that might change if that kind of collateral backing those bonds, which is sovereign risk, goes into default.
Of course, something we've been discussing in the studio a lot today is the World Bank loan for Eskom. Some of the companies that are going to benefit from that are Exxaro, which was the main coal play on the JSE. Of course, Optimum Coal was listed recently on the JSE. In fact, it was listed by you guys. Do you think that's another company that investors should be looking at as a beneficiary of these coal-fired power stations?
Yeah, absolutely. I mean, Optimum is probably more of an export coal play. It's also a thermal coal, so for gas-fired power stations. But their earnings is much more driven by the exports that they do through Richards Bay into markets like India in particular and Europe. So the answer in short is yes. It's a very good play on a weaker rand and a strengthening thermal coal price globally. So it's not just driven by Eskom's desires to build coal-fired power plants in South Africa, but also other emerging and developed markets' desire for more power. And it's a much more pure play on the coal price than Exxaro, where Exxaro is actually predominantly an iron ore company. Something like 75% of the value of Exxaro is made up through its shareholding in Sishen Iron Ore. So actually, while it's a coal play, Optimum is much more of a thoroughbred coal play than Exxaro.
So that would be the only real coal play on the JSE,
Absolutely.
a pure coal play?
Yep. If you bullish coal, Optimum is your name.
Talk to us about FirstRand, because you placed a large line of stock in that group yesterday, didn't you?
Yeah, we did. I mean, I think what's quite interesting about that is and probably true also for the IPO of Optimum Coal, is that it does feel like we're in a situation in the markets where the buyers of equity assets are much more price sensitive than they were probably 6 months ago. And so we saw it in the FirstRand block that we placed. Even though that went very well, it was probably at a slightly wider discount than I would have expected.
We did see that share price coming under significant pressure yesterday, though,
yeah.
but then the financials were down, weren't they?
That's right, and so it was a little bit hard to disaggregate how much was because you're placing a block and how much was because just the market was weak and banks in particular were weak. But we placed that block at a 4.5% discount to the previous night's close, which for a liquid stock, I mean, it was a lot of stock. It was 1.5 billion rands worth of stock, but it's quite a wide discount. And then Optimum Coal as well was priced towards the low end of our expectations of where we would have priced that asset in the market. So I think what it's telling you is that investors are interested in equities, but they're only interested in it at the right price. And what we're actually seeing is that the local demand for these block placements in particular is better than the offshore demand. I think the foreigners are probably sitting on their hands more than the local investors. And where we are seeing activity, it's generally investors, if they are buying assets in equities, they're generally having to sell something on the other side of it. So what we saw yesterday, for example, is investors were selling Standard Bank and Nedbank to buy their FirstRand position. And we know what we saw leading up to Optimum Coal was that also investors had to sell some Anglo American or Billiton, say, to buy Optimum Coal, and makes it much harder to convince buyers of the asset to pay up when they actually have to sell something on the other side to do so.